Good morning. Today's topic is how do I convert my solo 401k to Roth? We will also go over your questions. So go ahead and type those questions over. It doesn't have to be regarding today's topic. It can be regarding any topics surrounding solo 401k plans, self-directed IRAs, business financing, 401k, and even traditional 401k plans. And we'll pause and answer those questions as they come in. So today's topic again is how do I convert my solo 401k to Roth? In today's webinar, we're going to break it down exactly what you need to know about Roth conversions inside a solo 401k. We'll talk about why you might want to do it, when it makes sense, and the steps you need to make in order to avoid unnecessary taxes or penalties. Please also like today's video. Also subscribe to our YouTube channel so that you receive notifications when we go live. We generally go live at least once a day, oftentimes twice a day. It looks like today we'll be going live again at 1 p.m. Pacific time. So if you don't get a chance to ask all your questions today, you're going to have a chance to ask them when we do our second webinar later today. All right, so again, go ahead and type over any questions you have during the live stream, and we'll pause and answer those questions as they come in. So converting solo 401k funds to a Roth. I'm going to talk about that. So why convert to a Roth? Well, there are several reasons. One is that when you convert to a Roth, specifically from the pre-tax solo 401k, so let's say you transferred IRAs or former employer plan funds to the solo 401k, or you've made pre-tax annual contributions to the plan, those amounts can be converted to the Roth solo 401k. And one of the reasons individuals convert from the pre-tax solo 401k to the Roth solo 401k is because they want to have tax-free growth inside that Roth solo 401k once those pre-tax funds have been converted. Of course, when you convert those pre-tax solo 401k funds or even assets like real estate, private equity, cryptocurrency, and so forth, when you convert those assets from the pre-tax solo 401k to the Roth solo 401k, it's going to be considered a taxable event because you are converting pre-tax funds that have never been converted, nor have they ever been taxed. So it's going to be a taxable event, but the trade-off is that the future growth of those funds and their assets will also grow tax-free. Now, we also have the mega backdoor Roth solo 401k, and that makes a lot of sense too, because the mega backdoor Roth solo 401k is a strategy whereby you are making voluntary after-tax solo 401k contributions to indirectly max out your Roth solo 401k funds. Because typically you can only make employee Roth solo 401k contributions as well as employer Roth solo 401k contributions, and oftentimes those two amounts don't get you all the way up to the overall contribution limit, which is $70,000 for tax year 2025, for example. By utilizing the mega backdoor Roth strategy, you can make a voluntary after-tax solo 401k contribution all the way up to the overall limit of $70,000, and then turn around and convert that immediately to the Roth solo 401k. So that's another time where it makes sense to convert, because you don't want to make voluntary after-tax solo 401k contributions and just let those funds sit in that bucket. Why? Because those gains will be taxable when you distribute those. That's why you want to, that's why as soon as you make those voluntary after-tax solo 401k contributions, you want to convert them over to the Roth solo 401k immediately so that all the gains grow tax-free along with the contribution. Of course, the contribution when you make it as a voluntary after-tax solo 401k contribution is non-deductible, meaning you don't get to reduce your taxes for the year in which you make the contribution. Likewise, when you go to distribute those funds, once they've been converted to the Roth solo 401k, you're not going to have to pay taxes or penalties as long as you meet a qualifying distribution event. We've talked about those Roth solo 401k qualifying distribution events in past webinars, but we can discuss them if you have any questions on that front. Looks like we've got a question here. Let's pause and answer that question, and then we'll come back and continue with today's topic, which again is, how do I convert my solo 401k to Roth? How do I ask a question about Roth's transactions? You can either ask a question now, or you can go, if you're an existing client, go ahead and submit a support ticket, and we'll go ahead and address those questions. So you can email them to us. You can also schedule a call and we can discuss those with you. Let me send over a link to our support ticket here. So you can submit a support ticket if you want to email us those questions. We get a lot of questions by email because we can reply with a really detailed answer depending on your situation. So let me go ahead and shoot that over here. Okay, I sent over a link to our support ticket. All right, so we've been talking about why convert to a Roth. Now let's talk about when it makes sense. Well, we talked about how it makes sense if you're utilizing the mega backdoor Roth solo 401k strategy, where you're making voluntary after-tax solo 401k contributions, and then those contributions are immediately converted to the Roth solo 401k or even to the Roth IRA. Other times when it makes sense is to convert in years when you're going to be in a lower tax bracket. Why? Because when you convert pre-tax solo 401k funds to the Roth solo 401k, it's going to be a taxable event, and it's going to be treated as if you received a W-2 wage, meaning it's going to be taxed at the earned income tax rates, which may bump you into a higher tax bracket. Let me see if I can share a screen here regarding tax brackets. Give me a moment here while I look that up here. And we'll talk about tax brackets at a high degree, at a high level. Okay, let me share my screen here. Okay, so again, we're talking about when it makes sense to process a conversion of pre-tax solo 401k funds to the Roth solo 401k. As I already stated, anytime you convert pre-tax solo 401k funds to the Roth solo 401k, that's a taxable event, which means it may bump you into a higher tax bracket. So you want to take into account when it makes sense to convert. Obviously, it's going to make sense to convert in years when you're going to be in a lower tax bracket. So for example, for tax year 2025, here's a breakdown of the various tax brackets. And you see that the U.S. federal tax bracket is progressive. So it goes up in percentage based on how much W-2 wages you make, how much earned income you make. So obviously, if you're going to be in a low tax bracket for tax year 2025, let's say a 10% tax bracket, which means you're going to make less than $12,000, then it might be a good year to convert pre-tax solo 401k funds, because that's going to be treated as if you received a paycheck. Likewise, if you're not going to have any earnings from self-employment or any other earned income in 2025, then it may make sense to convert this year as well. You can do partial conversions. You don't have to convert all the pre-tax funds. You can convert some this year, and just that amount would be taxable, and then next year you can convert an additional amount. You can also convert assets. Let's say your solo 401k holds stocks. Let's say you invested in a stock that is really down now, that due to market conditions, it's got a really low value. You can actually convert that stock to the Roth solo 401k, so you do not have to liquidate that stock, and you're going to be taxed on the value of that stock. And then the future gains on that stock will grow tax-free, and later on when you sell it, it'll go back to the Roth solo 401k and continue to grow tax-free. Same thing with real estate. Let's say you own a rental property inside your pre-tax solo 401k and it's gone down in value. You can convert that value of that property to the Roth solo 401k as an in-kind conversion, and you'll pay taxes on the current market value of that property. You can also convert part of that property to the Roth solo 401k and then later convert the other value, the other ownership of that property to the Roth solo 401k as well. In other words, you can process partial Roth solo 401k conversions of assets as well, whether it's private equity, real estate, cryptocurrency. Let's say that your cryptocurrency goes down in value. You can, and it's owned inside the pre-tax solo 401k, you can convert that lower value cryptocurrency in kind to the Roth solo 401k and only pay taxes on that lower value converted. And then all the gains will grow tax-free. So again, it makes sense. It may make sense to convert in years that you're in a lower tax bracket. Another item to understand is you want to make sure you have enough liquid funds in your personal bank account to pay the taxes due on that conversion, because you have to pay the taxes due on that pre-tax solo 401k conversion with personal funds. And you don't pay those taxes until you file your taxes next year, unless you're paying estimated taxes. But the takeaway is that you have to make sure you have enough funds in your personal bank account to pay the taxes due on that conversion. They cannot be paid with funds from the solo 401k when you process that pre-tax conversion. So it's very important to understand. Okay, let's see here. Again, go ahead and type over your questions regarding today's topic or any topic, and we'll answer those as they come in. In the meantime, we're going to continue to talk about today's topic, which is how do I convert my solo 401k to Roth? Another item to understand when processing a conversion of pre-tax solo 401k funds to the Roth solo 401k is that if you are processing a conversion of the pre-tax solo 401k funds, you generally cannot convert those to the Roth IRA. They have to be converted to the Roth solo 401k. That's different than voluntary after-tax solo 401k contributions that are converted. Those can be converted to the Roth solo 401k or the Roth IRA, even though most clients prefer to convert to the Roth solo 401k for various reasons. But if you are converting pre-tax solo 401k funds and you want to convert those to the Roth IRA instead of the Roth solo 401k, you can only do so under certain conditions. Condition one is if you're age 59 and a half or older, you can convert those pre-tax solo 401k funds to a Roth IRA. If you convert them to the Roth solo 401k, there's no age requirement, meaning that you can convert them even before you reach age 59 and a half. Now, if you've transferred IRAs or former employer pre-tax funds to the Roth solo to the pre-tax solo 401k, that is, those can be converted to the Roth solo 401k, or those can be converted to the Roth IRA because those came in from a previous employer plan or a traditional IRA or a SEP IRA or a simple IRA. So there are certain little rules like that that apply when you're converting pre-tax solo 401k funds. So you're going to want to make sure you check with your solo 401k provider before you process any type of conversion, whether pre-tax solo 401k funds or voluntary after-tax solo 401k funds. But specifically, you really want to concentrate on understanding the rules with converting pre-tax solo 401k funds, because those have more stringent rules. So make sure you make note of that. Now, when you process a conversion of pre-tax solo 401k funds, there are certain steps you have to take, which are very similar to when you convert voluntary after-tax solo 401k funds to the Roth IRA. So let's talk about the steps to convert pre-tax solo 401k funds to the Roth solo 401k. Well, first, you have to make sure that they qualify. And we just talked about some of those rules. So again, generally, you can convert pre-tax solo 401k funds to the Roth solo 401k. And you can be any age, over 59 and a half or under age 59 and a half for that matter. So first you want to identify, do you want to convert the pre-tax solo 401k funds to the Roth solo 401k or to the Roth IRA? If you want to convert it to the Roth solo 401k, then you don't have to meet any type of triggering event. If you want to convert it to the Roth IRA, as we already touched on, you can only convert funds in that pre-tax solo 401k that you transfer from IRAs or former employer plan funds. And that's if you're under age 59 and a half. If you're over age 59 and a half, then you can convert any funds in that pre-tax solo 401k, including contributions to the Roth IRA. But if you're converting pre-tax solo 401k funds, those can always be converted to the Roth solo 401k regardless of your age and regardless of type. So let's say you're going to convert the pre-tax solo 401k funds to the Roth solo 401k. First, you want to discuss with your financial advisor whether you should process a conversion this year, because again, maybe you're in a high tax bracket and your advisor may say it's not a good idea to convert this year because it might bump you into a higher tax bracket, because the amount converted is going to be subject to income taxes. If your advisor says yes, you should convert, then you want to identify, am I converting cash or am I converting assets such as real estate, cryptocurrency, stocks, and so forth? Or am I converting both? If you're converting cash, then there's no valuation that needs to be performed. That's pretty straightforward when you're converting cash. But if you're converting an asset, like let's say real estate, let's say you own a rental property inside your solo 401k and you want to convert that property, you first need to get a fair market valuation and appraisal, because the amount converted is going to be taxable, the market value. So that property needs to be converted at fair market value so that the IRS collects the applicable tax revenue, because again, it's going to be a taxable conversion. If you're converting the cash, then or an asset, you need to make sure that you open up a second holding account if you haven't opened it up already to hold the Roth solo 401k funds. Again, a solo 401k allows for pre-tax funds, Roth funds, and voluntary after-tax funds. So it's considered just one plan, but you have to have separate holding accounts, whether it's bank accounts or brokerage accounts, for each source of funds. So one brokerage account to hold the pre-tax funds, a second brokerage account to hold the Roth funds, and a third brokerage account to hold the voluntary after-tax solo 401k funds. When you convert those pre-tax solo 401k funds or assets to the Roth solo 401k, the cash gets moved over to the Roth solo 401k bucket. If you haven't yet opened up the Roth solo 401k brokerage account and you're a client of my solo 401k financial, we can assist you in doing that. Same thing with the bank account. If you want to use a bank account, Once that Roth Solo 401k bank or brokerage account is ready, then it's time to move the funds from the pre-tax Solo 401k bucket to the Roth Solo 401k bucket. If we're talking about an asset such as real estate, a rental property, then that property, the recorded deed, doesn't necessarily have to be updated because it's still the same solo 401k, but you can, if you want to, but it's not a requirement, you can update that property deed. It's still going to list the same solo 401k name, but in parentheses you would put the word Roth. But again, it's not a requirement. What's important is that any rental income, once that conversion has been processed, that in-kind conversion to real estate has been processed, which is going to trigger a Form 1099-R to report that conversion to the government. Once that conversion has been processed, future rental income will flow to the Roth Solo 401k bucket, the bank account or the brokerage account for that Roth Solo 401k. Same thing when you later sell that property owned by that Roth Solo 401k. The profits will flow back to the Roth Solo 401k. From a planning perspective, you can always distribute that Roth Solo 401k owned real estate. Once it's inside there, you can distribute that as an in-kind distribution, so that property can be distributed in your name later on once you have reached age 59 and a half and have had that Roth Solo 401k for 5 years. You can take a tax-free distribution of that Roth Solo 401k on real estate, for example. So keep that in mind. That might be a strategy to understand a little bit more. And then once you've converted those pre-tax funds or that pre-tax owned asset like real estate to the Roth Solo 401k, you then need to complete our conversion form on our website. It's called an in-plan conversion form, so that we collect the necessary information to issue that Form 1099-R. And if you process that conversion here in 2025, you need to make sure you process the conversion by 2025 so that it's treated as a year 2025 conversion. And then the Form 1099-R to report that conversion will be issued in January, February of next year, so 2026. A copy will go to the IRS and a copy to you. For clients of my solo 401k financial, as long as you timely request that Form 1099-R, we won't charge additional fees. That's covered in our annual fee. So that's why a lot of our clients like to use us, because they don't get charged extra for those conversions as long as they timely request it. Now, if you're doing the mega backdoor Roth Solo 401k strategy, it's very similar with regards to the steps involved, except you're going to make the voluntary after-tax solo 401k contribution to the voluntary after-tax solo 401k holding account, aka a bank or brokerage account. Let me share a screen here that goes over the various holding accounts for the solo 401k to help paint that picture. Give me a moment here. So let's see here. Give me a moment here. Okay. So when you're converting voluntary after-tax solo 401k funds to the Roth Solo 401k as part of the mega backdoor Roth Solo 401k strategy, you first need to make the voluntary after-tax solo 401k contribution to the voluntary after-tax solo 401k holding account. So here's an example of a one participant plan. Let's say your self-employed business is an LLC, taxed as an S corporation, and you're the only employee in the company, and you open a solo 401k plan. The solo 401k plan will be sponsored by that LLC. So just one solo 401k will be opened. The solo 401k allows for pre-tax solo 401k contributions, Roth solo 401k contributions, and of course, voluntary after-tax solo 401k contributions. So in this example, you would make the voluntary after-tax solo 401k contribution to the voluntary after-tax solo 401k holding account. So let's say you have a brokerage account. So that you would make it into that bucket. And then let's say you want to convert those funds to the Roth solo 401k. So the contribution would go into that after-tax bucket, and then it would immediately get converted to the Roth solo 401k bucket. So let's say you pay yourself $70,000 of W-2 wages in 2025 from your self-employed LLC taxes and S corporation. You can contribute that entire $70,000 to the voluntary after-tax solo 401k bucket. So the bank or brokerage account, and then turn around and convert it to the Roth solo 401k bucket, resulting in $70,000 in Roth solo 401k funds. We talked earlier about how you can convert pre-tax solo 401k funds to the Roth solo 401k as well. So you would transfer IRAs, former employer funds, or make annual contributions, pre-tax contributions. They would all be deposited into this pre-tax solo 401k bucket, and then it can get converted to the Roth solo 401k bucket as a taxable event. Now back to the Roth solo 401k. So once you've made that voluntary after-tax solo 401k contribution and then converted it to the Roth solo 401k bucket, you need to make sure that you complete our online conversion form after you've moved those funds, and you want to do that by the end of the year so that you get credit for it this year. And then we'll issue a Form 1099-R to report that Roth solo 401k conversion. And here's our Forms tab here. On the top right-hand corner, you can get to our Forms tab, and we have various online forms that you would fill out. Here's the one that you would fill out if you convert voluntary after-tax solo 401k funds to the Roth solo 401k bucket. If you convert pre-tax solo 401k funds to the Roth solo 401k bucket, you would fill out this conversion form here. And then once we receive that conversion form, that we're going to go ahead and issue that Form 1099-R to report that conversion to the IRS. And that'll complete the conversion. Looks like we got a question here. Let's take a look at that question, and then we'll come back and continue going over today's topic, which is how do I convert my solo 401k funds to Roth? And we've been talking about that at great length. And then let's see here. So the question here, if I'm 55 and I convert to get a 10%, do I get a 10% penalty? So no, conversions of the pre-tax solo 401k funds to the Roth solo 401k are never subject to a 10% penalty. It's subject to federal taxes and possibly state taxes depending on your state of residence. And keep in mind, you can convert pre-tax solo 401k funds to the Roth solo 401k at any age. And the 10% early distribution penalty never applies because it's not a distribution that you're making, you're processing a conversion. So the difference here is that you're not processing a distribution, you're doing a conversion. You're converting pre-tax solo 401k funds to the Roth solo 401k. So good question. And again, those can be converted at any age. You don't have to be age 59 and a half or older. Good question. Okay, so go ahead and like today's video to help get the word out to other solopreneurs like yourself. Please also subscribe to our channel so that you know when we go live, we'll send out notifications. So let's talk about some more stuff here. So Roth solo 401k contributions versus conversions. Well, contributions to a solo 401k, whether Roth, pre-tax, or voluntary after-tax, have to be based on your earned self-employment income. So if you don't have any earned income from self-employment, then you cannot make a contribution. And when you make a contribution to a solo 401k, you can make pre-tax solo 401k contributions, Roth solo 401k contributions, voluntary after-tax solo 401k contributions, or a mixture of all three, or you can just make voluntary after-tax solo 401k contributions. Many of our clients will solely make voluntary after-tax solo 401k contributions up to the overall limit, which is $70,000 for tax year 2025, and then convert it to the Roth solo 401k. So conversions is when you convert money from the pre-tax solo 401k to the Roth solo 401k, or if you convert voluntary after-tax solo 401k funds to the Roth solo 401k or the Roth IRA. So it's not a contribution, nor is it a distribution when you process a conversion. How much can you convert and when? There's no limit on the amount that you can convert. So you can convert any amount inside that pre-tax solo 401k to the Roth solo 401k, and it will not impact your annual contributions, because annual contributions do not impact the amount that you convert. So you can still make an annual contribution even if you process a conversion. As far as voluntary after-tax solo 401k funds, the amount that you can convert is the amount that you contributed as a voluntary after-tax solo 401k contribution. So let's say you contributed $50,000 to the voluntary after-tax solo 401k bucket. Well, that would be the amount plus any earnings on that $50,000 that would get converted to the Roth solo 401k or the Roth IRA. Now, let's say you have a former employer 401k. For example, I know that the Amazon 401k allows for voluntary after-tax 401k contributions. Let's say that plan has voluntary after-tax 401k contributions and you no longer work for Amazon. You can transfer those voluntary after-tax contributions from that Amazon 401k to the voluntary after-tax solo 401k bucket. And if it's 50,000 or a million or whatever the amount is, you can then convert that over to the Roth solo 401k or the Roth IRA. And that will not impact your annual contributions. We talked about the tax implications that you want to understand when processing a conversion. So when you convert pre-tax solo 401k funds, we discussed how the amount converted is going to be taxable because those are pre-tax funds. So you want to make sure you understand that it may bump you into a higher tax bracket. So it may be best to convert in years that you are not in a high tax bracket. And you also want to make sure that you have funds outside of the solo 401k. So funds in your personal bank account to cover the taxes due on that conversion, because those cannot be paid with those funds from the solo 401k. We talked about some smart strategies to think about to save on taxes. That means converting years that you're in a lower tax bracket. Also, if you hold assets in that pre-tax solo 401k like stocks, and those stocks have taken a hit because of market conditions, then you can convert that stock at a lower value, and you're only going to have to pay taxes on that lower value, and then it'll get converted in kind to the Roth solo 401k. And if the market shoots back up, all those gains will be tax-free. Same thing with real estate or even cryptocurrency. Those can be converted as in kind at a lower value if the market's not doing well. And then once they're inside the Roth solo 401k, all the gains will grow tax-free. So those are some things to understand. All right, looks like we've got some questions here. We're also coming to the end of our daily webinar. We'll be live again here in a few hours. So if you want to ask any other questions now, make sure to shoot those over and we'll answer those. So we've got a question here from Phil. I might have missed it. When is the deadline to convert solo 401k pre-tax funds to the Roth? By December 31st, April 15, or October 15? Great question. So keep in mind that the contribution rules are different than the conversion rules, meaning that from a contribution perspective, if you're making an annual contribution to the solo 401k, you have until your business tax return due date plus timely filed extension to make that contribution for the prior year. Whereas a conversion, those conversion rules are different. Conversions are taxable in the year that the funds are actually converted to the Roth solo 401k. For example, let's say here in 2025, you want to process a conversion of pre-tax solo 401k funds that you contributed for this year to the solo 401k. You need to convert those funds by December 31st of 2025 of this year to the Roth solo 401k to count as a conversion for tax year 2025. Because conversions are taxable in the year that the funds or assets are actually deposited from the pre-tax solo 401k bucket to the Roth solo 401k bucket. So great question. So December 31st is the deadline to process any conversion so that it's taxable for that particular year. All right, so that it counts for that particular year as well. Looks like we've got another question here. Someone who does not identify themselves, which is fine. Question here. What's the difference between the conversion of pre-tax to Roth solo versus voluntary after-tax to your Roth solo? Great question. When you convert pre-tax solo 401k funds, that's a taxable event because those funds have never been taxed. They were deposited into the solo 401k as a pre-tax contribution. You got a deduction, or there are gains, or maybe you transferred a pre-tax 401k from a former employer plan, or a traditional IRA, or a SEP IRA, or a simple IRA to the solo 401k, and they're all pre-tax funds. So those are all taxable. As far as voluntary after-tax, that's part of the mega backdoor Roth solo 401k strategy, where you utilize that mega backdoor Roth solo 401k strategy to indirectly get more Roth 401k money into your Roth solo 401k. And when you convert that, you want to convert it immediately so that there are no gains. And those will get converted to the Roth solo 401k from the voluntary after-tax solo 401k. If there are some gains, usually it's a very small amount, just the gains will be taxable. Of course, you don't get a deduction on your taxes for the year that you make the voluntary after-tax solo 401k contribution. Good question. Another question here. Does the contribution to the voluntary after-tax have to come from a W-2, or can it come straight from our S-Corp? Well, contributions to a solo 401k plan have to be based on your earned income from self-employment activity. If your self-employed business is taxed as a sole proprietorship, for example, then the contribution is going to be based on line 31 of your Schedule C. That's the earned income from self-employment activity. That's the starting calculation for the contribution. If your business is taxed as an S corporation, let's say an LLC taxed as an S corporation, then the contribution is going to be based on your W-2 wages that you receive from that LLC self-employed business tax as an S corporation. So the contributions will be based on those W-2 gross wages. Whether the contribution goes directly into the solo 401k from the bank account for your business or from your personal bank account, it doesn't matter. What matters is that you have the darn W-2 wages to support that contribution and that you properly report it on your taxes. Great question. All right, it looks like we don't have any other questions for now. I've enjoyed our time today. We'll be back live again here in a couple hours. We'll be back live again tomorrow at 10 a.m. Pacific time. Again, please like our video to help get the word out to other solopreneurs. Please also subscribe to our YouTube channel so that you receive notifications when we go live. Until next time, have a great rest of the day.